this so we can show a loss. So if we sold it for 12, what would we get? We would get, again for cash, we would get 12 cash. 12 cash comes in, right? We got to write off the full value of the investment is minus 13. And then what's the other one? Is a loss, minus 1 loss on the sale of the security. And that is how the equity method works. Now when we do consolidations, that's when we own over 50%. So, greater than 50%, consolidate. And basically, here's what it looks like. So we have, the parent here. They've got their assets, liabilities, and owner's equity, okay? And then they have their income statement, revenues minus his expenses is net income. So there's the parent. And then we have the subsidiary. Assets, liabilities, owner's equity, revenue, expenses, net income. Now we're going to add these across. But, as I said, what we got to do here is we have to eliminate the intercorporate transactions. So if there's sales going on, let's go down here to the income statement. Here is the income statement. Here is the balance sheet. So, on the income statement side, if there is revenue between these, we have to subtract out this plus this minus intercorporate transactions. And same thing with the expenses. So the revenues, the sum of the revenues is going to be, they're added together less any revenues they have between each other. Same thing with expenses and cost of goods sold as part of expenses, okay? Now up here, we'll be doing the same thing, and there's going to be fewer consolidation eliminations. There might be some in like receivables and payables and stuff like that. Those will offset. So a payable that one has will offset against the receivable the other has between the two and so forth, right? But the big thing that's going to disappear, if you think about it, now think about this carefully, what really disappears is that one of the assets in the parents' books is going to be the investment. In other words, whatever they paid for this subsidiary, let's assume to keep it simple, it was 100%. All right? So there's this is going to be on the books, but what we're doing is we're actually taking this off the books and substituting all the assets and liabilities for them. So in the simplest case, and this is, hand-waving away a lot of complexities, this would be like 1,000, for example, this investment account, and if you look at the subsidiaries' assets, maybe they're 1,500 and 500 and 1,000. So see how these are the same? In other words, this takes the place of that when you add them together. And again, this is just not even assuming there's no intercorporate anything, related party transactions. So all I'm trying to do is show you that basically the subsidiaries' financial statements stand in place of that account on the parents' books called investment and subsidiary. That goes away, along with all the other intercorporate transactions and investments. So when you see consolidated, that's what they're talking about. And of course, we're skipping through a lot of very complex things, but this gets you the basic intuition of what's going on there. Well, I've given you guys a lot of materials, and I'll have some more stuff online for you. Feel free to email me or post stuff on the discussion board, and we'll go forward. Thanks very much for your attention.